Hi guys, welcome to my YouTube channel. So today's class is an audit opinion. In the next class we will do the paragraphs which will be included in the audit report, but today's class is primarily on audit opinion. So first of all, what is audit? Yes, so what is audit and what is the objective of audit? Audit is the examination of the financial statements which are made by the management, are examined by the auditor who is appointed by the shareholders. So why do shareholders actually appoint someone to check the truth and fairness of the financial statements prepared by the management? So why don't the shareholders believe the management? Why they have to appoint someone who's an external person, who's an independent person, to come and review the work and give them a reasonable assurance about the work of their own people, about the work of their own management? So for that you need to know about agency theory. Agency theory is basically the core reason behind shareholders appointing an external person to come and review the work of the management. Because agency theory is giving rise where there are two people, principal and the agent. The principal is the shareholders and the agent is the management. So principal is the one whose work is done by the agent and the agent is the one who does the work of the principal. Oh, confused, right? Anyway, so the management is the person, is the party who takes good care of the assets of the shareholder, because they are the stewards of the assets of the shareholders. The entity XYZ company actually belongs to the shareholders of XYZ company, but the person who's running them is different. The person who controls is different and the person who owns is different. So the owning party is the shareholders and the controlling party is the management. Now what is the goal or objective of the management? What do they want out of running a business? They want merely their salaries and their bonuses. So but what do shareholders want? They want just profit maximization. Now if you see, if I say the management wants to maximize their salaries, giving salaries out of your pocket is something known as expense and it will reduce my profit. But the aim of the management is not to reduce the profit as per the shareholders, but personal interests are greater than any interests in the world. So management is deemed to manipulate the financial statements so as to earn more and more salary and bonuses for their own personal interest, for their self-interest. So due to this reason, shareholders knocks the door of an external party, that is the auditor. Right then the auditor comes into the picture. This auditor is now what? He is the external examiner of the financial statements. And what is his objective? Why the shareholders have appointed him? The shareholders have appointed him to check the truth and the fairness of the financial statements. Now when he will check the truth and fairness of financial statements, what he'll do? He'll first plan the audit, right? What he'll do is he will he will test, the test of controls will happen, internal controls will be tested. Based on that, he will perform certain procedures on all the account balances, on all the transactions, on all the disclosures and everything, right? He will perform substantive procedures. Now in that scenario, after the procedures are being done, after the evidence is being gathered, now comes the stage of reporting. Now it is the time that when, for the purpose auditor was appointed, needs to be fulfilled. Now he will report his opinion about the financial statements, about the truth and fairness of the financial statements to the shareholders. So that is the time when the materialization of the objective of the audit is being fulfilled. So let's talk about what is audit opinion. Audit opinion is basically the conclusion on which the auditor reaches after certain stages, after a long process of examining, testing, and researching. So after gathering so many evidences and everything, he then gives a conclusion. It is either a good one or a bad one. Now, if I say that everything is true and fair, of course, that is a good one. Like, the management is integer, right? The management is true and fair. The financial statements are true and fair. They are free. They are free from material misstatements. Now, when the auditor is giving an opinion, he is not giving a ultimate assurance. He is just giving a reasonable assurance. Why? Because you can't tell someone that everything is 100% perfect. We are not gods, right? So we can just give a reasonable assurance that yeah, materially it is correct. Like, there are no material misstatements, so it is correct. That type of opinion will be known as unmodified audit opinion. I am not talking about the audit report. I am here talking about the audit opinion, right? So it is unmodified. When everything is true and fair, when every financial statement item is materially free from misstatements. Now, what is modified opinion? The auditor may modify his opinion just because he found some misstatement, and then the management didn't accept that fact. The management wasn't ready to rectify that misstatement. The management wasn't ready to correct that misstatement. So that is when actually the auditor, he gives a modified opinion. Now, modified opinion are again of different types. So let's discuss that now. Okay. The modified opinion depends on two factors. Either the reason for a modified opinion will be a material misstatement, right, which the management didn't correct, or it could be insufficient, you can say, audit evidence, or there was not proper information available to you. So that is the case when you are not able to access all the information due to some reasons which are out of the auditor's control, like inventory count happened before the auditor was appointed. So he can't observe that inventory count. So there is insufficiency of the evidence available. So there is limitation of scope, you can say. Limitation of scope either by the, you can say the management may say to the auditor that don't contact the previous auditor. So you can't perform the procedures in the opening balances. If you can't contact the previous auditor, you don't have enough sufficient and appropriate evidence available for the opening balances. So that is when there is limitation of scope or there is insufficient audit evidence. Now, in case of material misstatement, if there is material misstatement, there are basically two types of audit opinion being given. What are those two types? It is qualified, and the second one is the adverse. Qualified opinion and the adverse opinion. When I say qualified, I say, or the auditor says, that everything is true and fair, everything is free from material misstatements except for this particular item. So that particular item is just one, so it is except for, right? And that misstatement is material. That misstatement is material. Right. Now, what is the materiality? You guys know, I have told my students who have enrolled with me, you guys know it. Materiality is by nature or by size. So you have some thresholds for materiality by size. So using those thresholds, if that misstatement is material, it's just material, it's just single, so it will be qualified opinion. But when that misstatement is material as well as pervasive, then the opinion should be adverse. Now, what is the meaning of pervasive? It is a new term. You guys know about materiality, but you don't know about pervasiveness. Pervasiveness is when something is present in more than one account balances, like it is spread in whole of the balance sheet. The misstatements are there in whole of the balance sheet, so you will give a adverse opinion. But if that it's present in just one account balance, but that particular misstatement or that particular account balance forms a substantial portion of the whole of the assets of whole of the account balance, or that misstatement is a substantial portion of that particular account balance, then it will also be an adverse opinion because it is pervasive. For example, if there is a misstatement of 10,000 in the, say, plant and machinery, and in total plant and machinery or the total assets we have are, say, it is 15,000. So in that case, the plant and machinery, the misstatement in the plant and machinery is for 10,000, and in total assets you have is a 15,000. So it is a substantial part of the total account balance, and you need to understand that this is pervasive. Either it will be spread in the whole statement, or it will be a substantial portion of the account balance, right? So that is pervasiveness. Or there is incomplete or inadequate disclosure, or there is no disclosure about something which is fundamental to the user's understanding. Who are the users of financial statement? The shareholders, the potential investors, other stakeholders, right? The suppliers, the employees, everyone, they are the users of the financial statements. So if something is fundamental to their understanding, for example, about the going concern, that is something which is really important. So if that disclosure is not provided, that means it is fundamental to the user's understanding, and this makes it pervasive. Then about accounting policies, that is also fundamental, right? So that is when you give the adverse opinion. Now you have the second case where there is limitation of scope. In the limitation of scope, you don't have enough audit evidence, and so first one is same, qualified. If something about which you don't have information, if that is material, if suppose the the payroll documents got burnt in a fire, so in that case, that payroll expense, if it was material, then I will say that I will give a qualified opinion. I will say, except for payroll expenses, everything is true and fair. And then in the basis of opinion, you will tell that why you don't have the sufficient information about that particular expense or that particular account balance, right? Then you have the another type of audit opinion. What's that? That is disclaimer. Now, if you think that about something which I am not able to gather the information with, about which I am not able to get the audit evidence, if that something is, say, material as well as pervasive, I think it is really important. It is fundamental to the users, and it is substantial part of some account balance, and I don't have enough information about that. So in that case, I will give a disclaimer of opinion, a disclaimer of audit opinion I will give. So let's read these things from the technical articles given by CCA itself. Let's have a look at that. Yeah. So the auditor concludes, about unmodified opinion when everything is true and fair. What is modified opinion? Qualified, adverse, disclaimer. Qualified is when an uncorrected misstatement or inability to get sufficient and appropriate audit evidence is material. So qualified opinion is present in both the cases, MMS and the inability to get sufficient and appropriate evidence, right? Adverse is just there in the first case, that is uncorrected misstatement, and it is both material and pervasive. Then disclaimer of opinion is when there is inability to get sufficient and appropriate audit evidence and it is material and pervasive, right? So this is disclaimer of opinion. Now let's see about the first. What is the wording exactly? You know about whatever is written on your screen. I have discussed with you. So first scenario is MMS, that is uncorrected material misstatements. So first I will calculate the materiality. If it is immaterial, I will leave it there and then I'll say okay, give an unmodified opinion. I don't care about this. Okay, so you will not care about this and you will give an unmodified opinion. But if it is material, if it is in these thresholds, if it is over these thresholds, then you will give a modified opinion that is qualified and you will use the word except for. So what is the wording? In our opinion, except for the effects of the matter described in the basis of qualified opinion paragraph, which we will do in the next video, the financial statements present fairly in all material respects, give a true and fair view of all the financial position of ABC company as at the 31st December 2001 and of its financial performance and its cash flow for the year then ended in accordance with international financial reporting standards. So it is very basic kind of wording which is used. This is available, you can just copy paste them. Anyway, this won't be asked in your exam. You just know, you should just know about the scenarios when you will give this kind of opinion, whether it is unmodified, modified. In modified you have two situations, MMS and the inability to get the sufficient and appropriate audit evidence. In MMS you are having two kinds of further audit opinion. Number one is the qualified, when the uncorrected misstatement is material. Number two is the adverse, when the uncorrected material misstatement is material as well as pervasive. And you know what pervasive is? Pervasive is not confined to the one account balance. Either it is spread in the financial statements, or it is a substantial portion, or it is fundamental to the user's understanding. Then that was the first situation. In the second situation, which you have inability to get the SAE, there you will get you'll get qualified opinion again, where there the inability to get the SAE is material, and then you will get the disclaimer where the inability to get the sufficient and appropriate audit evidence is material as well as pervasive. So these are the things described in these boxes, right? We have done this. So yeah, so for today it's okay, and in the next video we will cover the paragraphs and the report. If you like it, please do comment, and it will motivate me to make new videos. And of course, all the best.